Mistakes that I've seen companies make, not keeping track of their cash and their burn and just not having like a simple cash flow forecast to understand how much runway they have. So, a common challenge can be a business thinks they have 12 months left in the bank, and then suddenly they realize, oh no, we're at like 6 months and we need to start fundraising right now and we're not ready yet.
Hi, everyone. It's Daniel from the Just Paid podcast. I have Kim here today, who is a guest, who's actually an expert in finance. And I wanted you to give an intro of yourself, Kim, just for the audience, so they know who you are and what you do, and a little bit more about you.
Yeah, absolutely. Thank you so much, Daniel. Happy to be here. So my name is Kim Walch. As you said, I've had about 20 years experience in finance and accounting. I started my career initially in external audit at a regional CPA firm. I did that for 2 years, long enough to get the experience I needed for my CPA license. I do hold an active CPA license in California. And then after 2 years, I realized I wanted to go in-house. I'm a San Francisco Bay Area native, and being here just kind of fell into working at tech companies because that's where the jobs were, but found that I really love it. I love that it's fast-paced, it's high growth. I think back to like what I used my cell phone for 10 years ago, 5 years ago versus today, and I get really excited about the future of technology. And now with AI, like there's just so much growth, so much going on. It's such an exciting space to be in. In 2012, I joined a Series A startup called Scout that was backed by Andreessen Horowitz as their financial controller, reporting to the CFO. It was on a very small finance and operations team. So we did all things, finance, accounting, HR, admin. And it was a really great experience. After 3.5 years, the CFO left to start her own thing. And shortly after that, the company was being acquired by a publicly traded competitor. So I got to lead that acquisition effort, including, an initial 2-year audit, all the legal disclosures, due diligence, had to close an international subsidiary, just a ton of work all on top of my full-time job. But ultimately, the acquisition was a success and wound that entity down, transitioned the finance function over to the administrative headquarters of the new company, and ended up getting laid off, which was fine. Realized I didn't really want to be doing finance and accounting in a publicly traded company anyways, because SEC reporting is just not my jam. Took some time off and traveled. And then several months later, the CEO of that company approached me and was like, hey, I raised $3 million in seed funding, started a new, B2B enterprise SaaS company. Looking for someone to do all that finance, accounting, HR stuff that I hate and you seem to love. Are you interested? I was like, yes, this sounds great. So started working with them on a fractional basis. And then also was working part-time at a fractional finance and accounting firm that specialized in early stage venture-backed tech startups. And that was an amazing experience. I was there for 2.5 years and got to work alongside some of the best and the brightest fractional CFOs and accountants servicing Silicon Valley, got to dabble in industries like cryptocurrency, telehealth, SaaS with a hardware component, tangible goods and sales tax nuances. So just got a lot of great experience working there, and then ended up going full time at that B2B SaaS company. I'd helped them get through their Series A and then their Series B. And that's when the CEO and I talked and was like, hey, this should be a full-time job. So joined there. I was there full time in-house for a little over 3 years and realized I really missed working on a fractional basis with really early stage founders. I love being able to get in there right at the beginning and set things up to scale and grow, and decided to take the leap. And that was how I ended up starting my own boutique finance and accounting firm, Rio Finance, last year. So I've got a small offshore team of accountants and some other fractional CFO types who are local. And we support, primarily the early stage venture-backed tech startups, although we do work with other types of companies as well. And it's just been so much fun. I absolutely love it.
Got it. Got it. And I guess a little bit more about your background. So why finance? Like, why not something else? Like, why the finance space?
Like, why did I study accounting in college?
Yeah. Yeah. Why that?
Yeah. No, that's a great question. So I always loved math. I excelled in math from a very early age and absolutely loved numbers. I I actually dropped out of high school. I'm actually a high school dropout. I left early, but then did the California High School Proficiency Exam, which is the legal equivalent of a high school diploma, but only recognized in the state of California, and then went to junior college. So I was in junior college when I should have been like a junior in high school. And I picked my major then. And so I was 16 and I knew that I loved numbers and wanted to work with numbers, but I didn't really know what a mathematician did. And like, instead of looking it up, I was like, well, accounting, that's working with numbers. And I was just like a very practical teenager where I knew I'm like, if I get a degree in accounting, I will be able to get a job. It was a very unromantic, very like practical very practical approach. And I found studying accounting really, really boring. It is very dull to study. But then when I actually did the work and I did bookkeeping while I was in college as well and like went into audit after immediately afterwards, like I actually really love the work. So thankfully I stuck it out and learned it. But yeah,
Got it.
really, really, really love the work. But it is very dry to study accounting.
I guess like application is always more fun than like just theory, like with finance, because it's such a different space. But it sounds like you really took it at a practical level, which was like everybody needs that. Honestly, it's something that's just like needed in the United States. There's a shortage of like accountants, and then a shortage of like fractional CFOs, and people just doing this job. So I feel like you did pick a really it's a really great space to be in because people just need it. I guess one other question, like, would you recommend, this is more just for people going into finance, like just a few tips like on what direction they should take. Like you took the path of startups. Like, is there a specific path you recommend just from all of your learnings? Like, where would you recommend like the younger accountants graduating now or the people thinking about accounting? Like what path would you recommend?
Yeah, I would say, for anyone who's studying accounting, I would highly recommend going into public accounting after school. I just think you get to work on so many different types of clients and you learn a lot. Like, I don't feel like I truly understood how accounting works until I started actually auditing it. And then it kind of clicked. And I really understood how debits and credits balance and like how these entries flowed. And I think public accounting, it just makes you really, really smart. Like you work very hard, but you learn a lot. And I think even just doing public accounting for a couple of years, but maybe it's 2 to 5, 7 years, and then going into industry, like you'll just have so much more expertise and exposure that you'll be able to go into industry at like a much higher level than if you were to graduate with an accounting degree and then try to find a job, probably as like a bookkeeper or just a staff accountant.
I noticed a lot of people actually, you're calling out something like I've heard over and over again where people go into like public accounting and then they just figure it out after that. They have a lot of options where like they either build relationships with like a startup or they decide where they want to go and they kind of like hone in on where they really want to be. That's a really, really good, really, really good point. Any other advice for like the younger generation of accountants? Like, should they work for you? Like, or should they be working, like, should they be exploring or like doing conferences? Like, any other tips or tricks?
Ooh, that's a great question. I mean, it's so hard to say. I guess the number one thing I want to say is they should be learning the tools and technology that's available. I think, we're starting to use AI for a lot, and that trend is definitely going to continue. And I think they should think about what industries they find interesting and like what aspect of accounting do they find interesting. Is it, getting very technical and very detailed? Like when I used to have to do bank reconciliations, much more manually. We were still doing them in software, but like there wasn't a bank feed the way there is today where the system already knows that this cleared the bank account. So it was like very manual. When I got a bank reconciliation to tie out to the penny, like that was a very satisfying feeling. And I really enjoyed kind of the black and whiteness of accounting. Like, did you do it wrong or not? It's very mathematic in that way. Like there's one answer. And so I think for someone where that's what they feel passionate about and that's what they enjoy, like that person might really like a very technical role. They might find they really enjoy, that publicly traded company where they're doing like SEC reporting and there's a lot more technical nuance. I personally love working with startups because I love rolling up my sleeves and getting into the details, but also still having that high level overview of what's going on with the business and being able to wear many hats and have that bird's eye view. So I think it's really, I think it's helpful to kind of understand like what is it that you like and then optimize for that.
Got it. That's really, really, really good advice, actually. One question, like, that I think every founder has, like, when do you need an accountant? When do you need a finance team? Do you need it at the earliest stages? Like, when do people hire for that? And this was a question like I didn't know when I started my first company, which I literally started it and just was unsure of like that space. Like, what do you recommend for founders at what stage?
Yeah, absolutely. I think that's a great question and a really important one. I think companies need finance and accounting really from the very beginning, but that role is going to evolve a lot over time. So initially, primarily what they're going to be doing is a lot of bookkeeping and just making sure like, the company has some money, they're spending money, that that's categorized correctly. Obviously, you need that for taxes. You just need to know how much cash you have left. You need to be able to understand your expenses. And bringing in a team that understands that from the beginning, I think is really, really valuable. It's not necessarily a lot of work. I think for a lot of, very early stage businesses, they have a relatively low volume of transactions. It's not very complex. So it shouldn't be very expensive. It's not actually a ton of work, but I think it's so, so helpful to have that information right. I mean, the idea of being a business owner and not actually understanding how much cash you have, like, how can you run your business if you don't even know how much cash you have? And understanding, how much you're spending each month and what your burn looks like. It's very important. And just having a decent, not even a great, having a decent accounting team and a decent finance function really just helps and goes a long way.
A lot of founders are like, I don't have any customers yet. I just raised like $20,000. Like, when is that moment when you say I need an accountant? Is it that very first moment? Is it like a year in when you have like $100,000 in revenue? Would you say you get someone immediately? Like, when you have some funding amount, like what is your mental model for that?
Yeah, I mean, honestly, I would say, even if you've raised $20,000, I mean, no, that's not a lot of money. And especially when you're thinking of these venture backed tech startups that are raising millions of dollars. But even if you've raised $20,000, like, you do need to keep track of that. And you need to understand, where you're spending that. Your business is going to have a tax form that needs to be done. And so you need to have that categorized correctly, if anything, for those compliance matters. So I think really right off the bat, you need to have some system in place for that. Now, I've definitely met founders who, maybe they're the MBA types and they have a decent understanding of finance and accounting and they feel comfortable doing that themselves. And in that case, I think that's great. If you've raised tens of thousands of dollars, you probably don't have a lot of complexity. If you're capable of recording these transactions on your own, then great, then save that money. A lot of the founders that I work with though, like that's really not their background. A lot of the founders that I work with are technical founders. They've built or they have a roadmap to build a really technical product. They understand engineering very, very well and how to write code. These are not necessarily the founders that also understand how to do basic bookkeeping or how to, categorize their expenses and their transactions to make sure that they have the information so someone can do their taxes. Right. So in most cases, I think there's a lot of value that can be added just by having someone with some finance and accounting expertise there to help. Now, again, if you've only raised, tens of thousands of dollars, you probably don't have a lot of complexity. This should not be very expensive. But I would say putting some money, investing some of your money into G&A can really avoid a lot of pitfalls down the line.
Got it. Okay. So you're saying you need an accountant immediately because of taxes and you want to track everything, but because it's such a small business at the start, it's not going to kill you in terms of price.
It
Uh,
really shouldn't.
Okay. Okay. So people need to like know what's happening. They should hire somebody. Like, how do you find somebody? Like, Would I guess there's different stages. Like, do they go to someone like you? Do they go to a smaller boutique firm? Do they go to like someone else? Like, what do they do? How do they find that person?
Yeah, I mean, hey, we love working with clients of all sizes. We're more than happy to work with very small clients. We don't charge any monthly minimum. We bill by the hour, and that really benefits our smaller clients where their books can be closed, in just a few hours a month. Like this might only cost them a couple $100s a month. It's, very, very, very affordable, very reasonable. A lot of folks have found me through referrals, through their networks. A lot of companies, when they get started, and specifically if they've raised funds, they've probably worked with an attorney on, getting their corporate documents set up, getting their fundraising documents set up. I get a lot of referrals from my attorney network. So, if you're a small business owner and you've worked with an attorney and now you're like, great, I need some help with finance and accounting. I mean, obviously reach out to me, but also, ask the attorney that you've worked with, ask your other service providers. They'll likely have good recommendations for you.
That's a really good tip. I didn't know that. So you should use your lawyer for
Yeah.
like some advice on who to go to for like other support systems.
Yeah,
Um,
absolutely. I think, any of the kind of G&A service providers that you work with probably have a good network of G&A service providers. I always tell my clients that's something I'm happy to help with. Like I have a vast network of folks like lawyers, all types of lawyers, corporate, immigration, trademark, employment law, but also people like insurance brokers or, if and when they need auditors, or maybe they're doing like a SOC 2 HIPAA audit down the line and they need auditors for that, right? Like I've worked with a lot of different service providers, and I'm always happy to make referrals to anyone in my network.
okay, so your accountant is not just, and your finance team is not just for the finances. You could also use them for other referrals. My accounting team in my companies in the past would just give me tools to use. So it was like, we need to use QuickBooks. Okay, got
Yeah.
it. We need to use this expense system. Okay, got it. So push a little bit and ask for this is for the founders out there. Ask like, who should I talk to for this to your accounting team? So because you're seeing things in a different light than a founder. Founders kind of like just they're working on their one problem all day long. You're kind of looking at it like, I've seen this company successful. I've seen this one. It's probably going to work for if you do it this way also. So like, what are some recommendations like that you have either in terms of software, in terms of like team that you need from the start? Like you need an accountant, clearly. It's only going to take a couple of hours a month. Should people use any type of, should they use QuickBooks from the get-go? Should they use something else or should they like not worry about it? Not worry about it? Like
Yeah.
what?
No,
Yeah.
great question. Great question. And I think, something that sets my firm Rio Finance apart from other kind of traditional bookkeeping and accounting firms, like we are folks who have worked almost exclusively with like early stage startups, really being in that operator seat. Right. And I think, to your point, there's a lot that goes into that beyond just like bookkeeping and accounting. And I think a lot of firms really specialize in just the bookkeeping, accounting, they know something about taxes. But if you start asking them, like, who should I go to for a SOC 2 audit? They're like, I have no idea. I've never worked on that. Who should I go to for, insurance broker? Like, they might not know. They might not have worked on that. They may have never helped a company fill out their, insurance applications. So, something that really sets us apart, like my background, I worked in startups on, very small teams or was a team of one for many, many years at like a B2B enterprise SaaS startup and did kind of all of that back office support that needs to get done and like literally no one wants to do. Your founder never wants to be the one filing all the little tax forms, chasing lawyers for things, but someone has to do it. And so, in terms of what would I recommend for folks to get started? I mean, QuickBooks is my favorite accounting software for small businesses. I think it's very easy to use and the reporting is really solid. Um, I will say I do hear from folks who don't have an accounting background that they find it really confusing. I think it's really made for people who understand accounting. So if there is a founder thinking about using it and like using it themselves, I would say it's worth sitting with an accountant and getting a little bit of training to make sure you're doing it correctly, because I think it's a little bit confusing for people who haven't studied accounting. There's a lot of great other tools and technology out there. There are some QuickBooks competitors. Xero, which is spelled Xero, is one. It's about half the price. It gets the job done. I don't like the reporting as much, but like it's half the price and it does get the job done. So that can be an alternative. I have a lot of folks in my network who have talked about like free programs that they've used. These are more like solopreneurs. So they have, really simple bookkeeping. I haven't tried any of those personally, but there definitely are some free tools out there.
So it
Yeah.
sounds like you work with more the true startup, right? Is that right? Or are you working with like non-startups as well? Like what's your
Pri Yeah, we have a mix, but primarily we're working with, like, the true kind of venture-backed early stage tech startups.
got it. Okay. I did work with like from years ago, I worked with like an accounting firm that wasn't a venture-backed account. They didn't work with venture-backed startups. And it did give me a weird perspective because they didn't really understand a lot of the venture world. And I think for founders, they should work with someone like you because you just get it's a different DNA. If you're creating a pizzeria versus like a startup, it's a very
100
different company. Yeah.
Yes, 100%. And I will say, like we're happy to support clients that don't necessarily fit that bill, and accounting is accounting. But to your point, there's a lot that is needed and expected and really helpful for like a venture-backed tech startup that a traditional bookkeeping firm might not be best suited for. So things like investor reporting, I've done that many, many times for many clients. All the investors want similar information, but they ask for it in a slightly different format in a slightly different way. But also, there's a lot of data that they're going to want to have, that they're going to expect to have, that actually lives outside of your accounting software. So, an example I'll give is ARR, which is annual recurring revenue. And I think for a non finance person, when you hear this term ARR and it includes the word revenue, you would think like, oh, that's going to be on my financial statements because it's revenue. But like, actually, it's not. Actually, ARR is not like a finance, and it's not like an accounting metric. Like it's not GAAP. It's not under generally accepted accounting principles. And I think that's very confusing and understandably confusing because it's not intuitive. So having someone who has that background, who has that kind of, experience working with startups, understands the metrics outside of accounting that are going to be helpful for the business to understand the current performance and understand, how they can improve their performance, and also to be able to communicate that to investors is very, very important. I'll, give an example. I'm working with a client. I started working with them, late last year, and they're like a Series B enterprise SaaS company. And they had been tracking their ARR in this really very, very simple waterfall model that they had gotten from one of their investors. And the model does a good job of telling you what your ARR is as of today, but it's not good at understanding your historic ARR. So it's really confusing when you're trying to understand, like, well, what did this look like a year ago? And how has ARR changed between customers? And like, how, just looking at these trends was like very confusing. And by the time I started working with them, they already had, millions of dollars in ARR. It was somewhere around like 8 million or so. And so for me to kind of go back and take all the data that I could find and put it together in a report, in a model that will show now the history is showing, their net dollar retention, it's showing year over year growth, like they're tracking CAR, which is contracted annual recurring revenue, also LAR, live annual recurring revenue. And like now we have all this data. But for me to go back and do that, one, there was certainly some estimation required, but two, it was a relatively heavy lift. Like it took many hours to, get this information compiled because there was so much historical data. There was a lot of back and forth with me and the CRO. Now, if I had been working with this client from the very beginning, and every time a new customer contract came in, I just reviewed it in real time, updated my report. And then, if a customer churns or something, like I'm informed of that, updating the report in real time. Like that lift, one, it just would have been spread out over many, many months. I think the data would be more accurate because there really wouldn't be estimates. Like we would just have all the data in real time. They would have had better reporting. They would have had better information. And honestly, I think it would have been less expensive for them. So I think it's so valuable for startup founders to work with someone who actually understands what is needed to work at a startup and who can work at startup pace. That is also something very different from the pace of, a traditional small business, right? I mean, we know working with startup founders, when they need something, they need it right now or they need it yesterday. Like we don't dawdle and take our time. Like we need to be right on top of things and making sure that they have access to information rapidly because things are changing all the time.
I was talking to one founder, and I think he has like $1 million in revenue, and he had a finance team, like he had an accounting firm, but they just did the accounting. That was it. And I was explaining to him that like having like a team member like you kind of can help raise funds also,
Oh,
which
yeah.
kind of blew his mind because he was like, "Wait, I could get someone to help me like model things out and create a story." Like I don't think a lot of founders realize like how important it is to have a finance team when you're gonna go for your Series A.
Absolutely. Absolutely. I think it's critical to have a financial model that you can show to your potential investors like, okay, I'm asking for, this much money. Here's what I expect to spend it on over this time frame and this is the outcome that I expect to have after I've spent this money. So, if you're talking about your initial round of funding, I think there's a bit less weight put on that because you don't really have a business yet. You don't really have a product yet. Like when you're modeling revenue for a company at that stage, it's very much you're taking an educated guess. And I think what your model needs to demonstrate is we have thought about how to monetize this product. We have some idea of how we're going to get users or customers. We have some sense of pricing. And we're modeling this out to show, like, yes, we think we can generate revenue, and these will be the revenue streams. Investors want to see that you're thinking about how to monetize the product. It's very important. But I think, at the earliest stages, they know, like, okay, these are kind of made up numbers because there's no history behind them. By the time you're Series A, the hope would be like, we have a product built at minimum, we've had some customers go through a pilot and we think we're going to convert them. These days, I think investors really want to see that you have some revenue and, you can expect some growth. And so when you're modeling that out, like some of these revenue numbers should be based on historical data and, actual things that have happened. We've sold 10 contracts at this dollar amount. So we think we're going to be able to sell 100 more over the next 2 years. And this is the data behind that. By the time you're at more like Series B, then you really need to be able to show we've had customers and we're able to retain them. And hopefully we're able to grow them as well. And that's when, you need to have that net dollar retention, which that metric is showing like what our customer base a year ago looked like compared to our customer base today. And you're hoping that it's over 100%.
I did notice like I call it like level steps, like in fundraising where you need your team more and more, your financial team. Like you called it out. It's like series seed or angels. If you get angels or series seed, they're betting on the founder or the space, right? Like it's like I like that this company does this, or I like that founder. But at Series A, they're looking at the revenue a lot closer, just thinking like, is there traction here? And generally, like from investors, they're like, I need like around $1 million. It doesn't have to be, but it's like, does this company have around $1 million in revenue, and I'll give them a Series A because proves some traction out. But you need an accountant and like a fractional CFO at that stage. Series B, you really need it because like it just gets more complex. I'm sure you've seen like the revenue gets messy, right? Yeah, is that right? Like, is it more
Oh,
messy at Series B or?
absolutely. There's just, there's a higher volume of transactions. The transactions have higher dollar amounts. There's more likely to be complexity. So at that point, it really is important that you have good accountants who understand the revenue model of the business and they understand how they should be recognizing that revenue from an accounting perspective. I've definitely seen some horror stories there. I was working with, well, am working with like a Series A enterprise SaaS company. We took over the accounting, and the previous accountants, I don't know what they were doing, but they had created revenue accounts for each state that the customer was located in. So literally you would run a P&L and L and it would be like sales California, sales New York, sales Texas. And okay, I assume they were doing this for tax purposes because you do need to apportion out your income by state for income taxes, keeping track of sales tax. Yes, like you do need this information somewhere, but like not on your P&L. Like on your P&L, you want to see, this is our revenue from our subscription. This client of mine, they offer like bespoke services. So having that allocated, I think that makes a lot of sense. And being able to see like what is coming, straight from your subscription and what's coming from bespoke services. Sometimes you see professional services included in revenue, right? Like there can be any number of revenue lines that make sense that really add value to have them allocated so companies can understand what they're selling by different product and service and bundles. But having it broken out by state, like, no, that's not helping anyone make a decision. That's data that's needed on the back end, and this is not the right way to present it.
Got it. So you're looking at the data in a different light, in a different way to really create a story. Like,
Yes,
under-
I look at data. I want to present data to founders that helps them make good decisions. And I think presenting financial statements on an accrual basis helps make good decisions. I also don't want to go overboard on US GAAP accounting when it's not helpful for decision making. So I'll give another example. So when a company issues stock options to employees, there's no cash involved when you do that. However, technically under US GAAP accounting, that is a non-cash expense item. A company that gets audited, they do a financial statement audit, like that's going to be reflected on their US GAAP financials. But that's not needed for general corporate income tax. And it's not helpful in making a decision. And it's very technical and nuanced for accountants to do. And if it's not adding any value, like, why do it? I feel like if I were to put that on a P&L for most of my founders, I would then need a line item to back it out. So we're talking about like, okay, what are actually your cash expenses? Like, what's actually an EBITDA, an earnings before interest, taxes, amortization, depreciation, right? Like, it's not helpful. And so, yes, it's very important to me that my team and I are delivering financial statements that are actually helpful to our clients and data that's actually helpful. So, like, ARR, like I was saying, or net dollar retention, or maybe we're looking at, customer acquisition cost or lifetime value. Like, all of this data is really helpful. And as long as you have clean data, it's very easy to do these calculations, have a little dashboard that everyone can look at that gets updated regularly. Like a lot of this, it's not hard to do. It's just a matter of having the data accessible and clean and in a format and having someone tracking it on an ongoing basis. And that's where I feel like getting in and working with companies at the very early stages when they have so little data or no data, but being there ready, like, okay, when you start making sales, like we'll start building out some dashboards, we'll start tracking it, we'll get some reporting for you. It's not hard and it's not that expensive, but it's so helpful and it just saves so many headaches down the line. Then later they get to, they're fundraising, like you said, trying to do a Series A and they realize like, oh, we don't have any data, we don't have any dashboards built out about our customers and these investors are asking for it and like now what? And now it's a fire drill.
so you build out the dashboards for founders in a nice, sane way where there's a story and it cleans up like the financial mess in some way.
Yes. Absolutely.
I do have something I want to say to like the listeners of the podcast. And this is more around like AI. I love AI. I think it's a zero trust tool where you can use it to learn and see. But I just heard a story yesterday of a founder who relied on AI and it reported incorrect numbers where it hallucinated.
Oh
And I
no.
think this is going to keep happening. So having a finance team like actually look at it is so critical still in this day and age, even with all these great finance tools. I don't think people are going to go away. And this is just my own thinking where it helps educate people at a fast rate, and it does raise like awareness, but like everyone needs a like Kim's team, like a team like yours, Kim, to like actually make sure things are legit and sane. I don't know if
Yes,
you have
no,
any thoughts on that. Yeah.
absolutely.
Yeah.
Absolutely, and I'm glad you brought that up because I agree wholeheartedly. It's very important to have that end user who understands, like, what is this supposed to look like and what are the calculations supposed to be. I think, AI is great, and I think it's gonna make us all a lot more efficient, and it saves a lot of time, and I really love that about AI, but yeah, I'm with you, just the other day, I was using Gemini in a spreadsheet that I was working on because I wanted help with the formula. And it was like a very complex formula. And I'm like, ooh, this would be a good use case for Gemini. And I explained to Gemini what I want the formula to do. And Gemini understood it and it put the formula in the cell for me, but it continually was using the wrong reference. Like I had it pulling data based on a date that was in the column headings, and it kept pulling the wrong, like there was the date, like the month, and then there was the date above it, like the quarter and the year. And it kept pulling the quarter and the year when it needed to be the month. So it was very easy for me to see what it had done, see where it's pulling the wrong reference, fix that reference, and now spread that down and out to the rest of the spreadsheet. And like ultimately it was helpful and it saved me a lot of time, but I needed to know like where it was doing it wrong and how to fix it. And yeah, I agree. It's we're not quite there yet to be able to just let the AI make all of our decisions.
A founder wouldn't catch that, and an executive wouldn't. Like, say you have your, chief revenue officer, maybe they might miss that, right? And you have a founder who's busy
Absolutely.
and they're doing a lot of different tasks, or a CEO, they're not going to catch that. So, like, a finance expert will catch that, right? And they're
Right.
checking everything. So, like, it's just critical. I think in my mind, I don't think finance teams are going to go away. They're just going to be more efficient, but you need them. Like, AI will make mistakes; it hallucinates,
Yeah.
and you know, people call it assume zero trust with AI stuff when it comes to
Right.
finances. Like, you don't want to rely on it whatsoever. You need a person to say, here's your real burn rate, right? I
Yeah.
mean, this is the way I believe in it, Kim. It's a people, like, people just understand the finances, and I don't know. AI hallucinates. It's very scary. So, but you're proving my point about it with Gemini.
Yeah,
Um,
no, absolutely. I think we will always need some finance people. I think I'm already impressed with how much technology can do and how much more efficient it's made everyone. When I look back on the finance teams that I sat on, in-house in companies 10, 15 years ago, and think about our workflows and processes, I mean, we were still receiving bills in the mail, mailing manual checks, keeping paper files, and these days we're all using, I mean, everything is completely paperless. Payments are electronic. We're using great systems for, to manage accounts payable, to continue with that example. And it's so much more efficient. And what that means is now people who manage accounts payable can do interesting work across more clients. They can spend, they're spending less time doing the very mundane data entry piece, and they're doing more time thinking about approval processes and, building out and scaling this function for more companies, or maybe they're, taking on other tasks at their in-house job. Like they're able to focus on much more interesting work. So I think it's been really great seeing all the improvements in the tools and technology.
I mean, it's definitely a new world. I'll talk about AI one more second. I'll just one more thing from my side. I heard having a safe word if there's an emergency, so you could have a phone call with your team, is critical. So, like, let's say we're working together, Kim, and you called me and it wasn't you, it was AI. So, like, it takes 3 seconds of your voice now to be like mimicked and copied and duplicated. It's very scary. So, like, you could mimic your voice and we're working together and you call me and you're like, hey, there's this emergency. We need to do payroll. Can you wire this money? I'm going to implement this internally in my company, which is the safe word. So you just say the safe word to me, which AI and a duplicate wouldn't be able to do. So say whatever it is, like say the safe word is coffee.
Mhm.
Then I would wire the money. So, like, this is one of those things where I'm like, oh, the world is really changing because you have to trust your finance team. You need like security words now and like things over the phone even. I mean, if we're on a Zoom call, it's you. I'm assuming it's Yes, it's definitely a crazy world now where like fraud is probably going to become more prevalent.
Yeah. Yeah,
Um,
absolutely. It is crazy. Well, and I'm even hearing about, like, avatars on video calls. I don't know, I'm hearing about that more in the context of, like, employee interviews and such, right? But, like, I don't know, I'm sure that's gonna come up with bank fraud and wire fraud.
right,
It is crazy.
right. It's
And
definitely
another reason why it's good to have an experienced human team that's gonna question these emails and these phone calls and such.
I guess just on that same vein, like what are some of the biggest mistakes you've seen companies do to fail as a company, like from your perspective?
To fail completely as a company?
On the finance side, like, were there things that they could do to save their company, where you just see you probably have a mental model, this company is gonna fail, most likely because you see it, or this company is, like, doing well. Is it, like, just I mean, there's this simple base case is, like, make something people want, which is, like, create something that creates value and you get revenue. That solves a lot of problems, but, like, you've seen a lot. So, like, what are those things? Like, of course, like, build something people use. Do people
Mhm.
undercharge? Do they burn too much? Like, what do you see as, like, big mistakes founders and companies do?
Yeah, I mean, I think the best piece of advice that I got in business school was, as founders, we get so focused on our product. And I think I see this a lot with, founders like these tech founders, they get so focused on their product and how great their product is when your focus really needs to be on your customers. And, you can build something that is absolutely amazing, but if nobody's going to spend money on it, like that's not going to be a good business. So really focusing on the customer and understanding like what does your customer want? What do they need? What are they willing to spend money on? Like what is the ROI that your customer is getting? I think that's really, really valuable. I think, mistakes that I've seen companies make, not keeping track of their cash and their burn and just not having like a simple cash flow forecast to understand how much runway they have. So, a common challenge can be a business thinks they have 12 months left in the bank. And then suddenly they realize, oh no, we're at like 6 months and we need to start fundraising right now. And we're not ready yet. I think that's a huge challenge. I think companies letting their burn get out of control. I've heard a board member say if the only goal your business has met is your hiring goal, that's going to be a problem. I think, making sure you've got the right talent and you're not hiring for roles that you don't yet need, right? Like you want to make sure I think making sure that your revenue growth is guiding when you're adding to your expenses. I think that's a really helpful and smart approach. So you just don't let your burn get out of control and run out of money.
Got it. Okay, so really keep an eye on it. Like, how often should teams look at it? Weekly, monthly, quarterly?
My recommendation would be monthly.
Okay.
What I like to do is build like a really simple cash flow forecast that's, it's based on your P&L, it's based on a hiring plan, it's based on some other, revenue assumptions, some other operating expense assumptions that we have. And each month updating it when your financial statements are ready and having, an update as of the end of that month. And then, I love to meet with founders on a monthly basis and say like, okay, this is what it looks like where you're at now. Here's where you spent money last month. Like, let's talk about what changes we can expect moving forward. We always will put together a hiring plan, but like you're working with humans, so you're never actually going to hire people on the exact dates for the exact salaries that you have in your hiring plan, right? Like that's a rough estimate. And, and maybe we're thinking like, oh, we thought we were going to need this salesperson in Q2, but now that we're looking at the numbers, you know what, we should probably push that one out until Q3 or Q4 and like making those changes. And again, this doesn't have to be a really time consuming, robust, expensive process. Like, this is something that could probably be done in, maybe 1 to 2 hours by a good fractional CFO, where it's like, great, I've updated the model. Let's talk about it. I mean, some of these things, I love to have a meeting and talk about it, but a lot of this, it can be done async. This can be some emails or some Slack messages. And now at least we have a simple but directionally accurate model. And we know, like, okay, it looks like you've got a good, 24 months of runway. Don't need to worry about running out of cash or fundraising right now. And that's great because now they know, like, cool, I'm safe to focus on other things.
Got it. Okay. So it's something that monthly. You're saying monthly check-ins and your fractional CFO or your maybe not accounting team. So what is the difference also between a fractional CFO and accounting team? Like what do you view that difference as? So you'd meet with your fractional
Yeah.
CFO, you'd sit down with them and then they would do what versus the accountant?
Yeah, that's a great question. So, accounting is really backward thinking. It's looking at transactions that already happened and making sure that they're categorized correctly and being reported properly. Which, to me means accounting on an accrual basis. And so that might be something like, hey, I saw you spent $12,000 on this 1 year subscription. This belongs in prepaid expense, and like $1,000 of expense should hit your P&L monthly, right? So that's the kind of things that accountants are really good at. They're very good at, making sure your bills are paid, your payroll's paid, your customers are invoiced and collections are being received, or they can follow up with them. But it's kind of that more backward thinking, like what has already happened and making sure that that's being presented accurately. Finance is really kind of the opposite. It's really looking at, okay, based on what's already happened, what's going to happen? Like what is the future? What are we strategizing? What insights can we gain from this that can help us make decisions to have better outcomes in the future? So, like we were talking about a cash flow forecast, understanding, okay, I've got $5 million in the bank. This is how much we're burning. These are changes we want to make. We want to, hire these team members. We want to invest a lot in marketing. We're going to start, attending these trade shows. We're going to start doing more digital ads. Okay, what do we expect to get from that, right? Like how many leads do we think we're going to generate from that? When we get a marketing qualified lead, how many of them convert to sales qualified leads? And then of those, how many convert to, opportunities? And what is the average sales cycle and how long does it take, and what percentage will convert to an actual customer? And then what do we expect that contract value to be? And right. And taking all of this data and like modeling it out. So we're like, okay, based on what we know about the business, we think if we invest $500,000 in marketing this quarter, we think by the end of the year, we might have, an additional 2 million in revenue. I mean, these are obviously completely made up numbers to illustrate, but like being able to have some data behind that as opposed to, just pie in the sky, like, oh, I think we should spend $500,000 on marketing because why not? Like, what are we trying to get from that? And how are we measuring if it was a successful outcome or not if we have no plan and no baseline?
Right. That's a really good point. I like what you said about like accounting being backward looking. And it's what you're saying is like CFO work is more forward looking. So like it's different pieces of the puzzle for like I guess your team. And your firm does both, right? Is that right? So you do
Yes. Yes, absolutely. So we do, full service finance and accounting. So everything from your, day-to-day bookkeeping, transaction processing, doing your month-end close, preparing your financial statements, and then all the way up to, recommending the right tools and technology, being proactive and keeping up on all of your compliance matters. Doing financial modeling, helping with fundraising, with due diligence, making sure you've got, all of your legal operations, all of your ducks in a row. And a lot of these legal things, just having someone to kind of project manage it, making sure the lawyers have the information that they need. So a lot of like the operations work as well that you just need someone doing to make sure that things get done correctly.
a lot of the firms just do accounting. So they don't do the fractional CFO work. So you're very different, right? Like and a lot
Yeah.
of founders will just go and get an accountant and then they kind of struggle with the fundraise because they don't a model is basically a spreadsheet of assumptions for everyone who's listening. But I guess like for you, like you can actually validate a lot of those assumptions where a founder might put something in there that looks off to an investor.
Yeah,
Like,
absolutely. Or also, a lot of times founders have ideas in their head of how they want to monetize their company, but they don't know how to put that into a spreadsheet and how to model it out. So, particularly with fundraising, it's a very collaborative process. It's like, okay, let's talk about, if you're talking about a pre revenue company, like, how do you expect to make money? And what are the different ways you want to make money? And like, how would you think about pricing or how much revenue you would get? And like, is this something, you're doing for every customer, or is this something like a big thing you're going to do once per quarter, like some sort of promotional sponsorship thing, right? There can be so many different ways, but so understanding, like working closely with the founder to identify and understand the revenue streams that they see for their business, and then being able to put that into a spreadsheet and then putting that into a model where then it's flowing into financial statements. And there's assumptions behind it. Like I saw one founder who was working with like a business advisor and had built a little financial model. And their revenue model just showed like, oh, we just think we're going to be at this by the end of the year. And then we're going to 5X the next year and then 3X the year after that. And I'm like, well, where did 5 and 3 come from? Like, let's build much more assumptions. Let's talk about like, okay, you've got a website. You're going to have, this many website viewers. We think that that's going to grow this much organically. We think you're going to pay for advertising that's going to get you this many more. We think you're monetizing, whatever it is, $1 per website viewer per month. And right. And building something out. And even if a lot of this, like maybe we don't have the data and these are our estimates and assumptions, like at least now an investor can come in and look and say, like, oh, there's a lot of math behind this. There's a lot I can understand. And do I think, one, they can grow and have, this many more website viewers? Do I think they can monetize $1 per month per website viewer if they're selling ads on their website? Is that a reasonable assumption? Yes or no? But at least it's a lot more than just saying like, oh, it's going to 5X.
right. And I think investors also sometimes when they say no, it's because they don't believe your numbers. I hate to say it, so like that he might have been shooting himself in the foot. These crazy numbers to investors were like it's so unbelievable. Have you seen that a lot in the past where like a founder will just like get too aggressive on their numbers or their numbers are so outrageous that the investor just they can't they might just say I'm not interested. They don't tell the founder the full truth.
Right. I mean, I think, to your point, I think investors can be very diplomatic with their rejection. So I don't think they necessarily say, like, I just don't believe your numbers.
Yeah.
But I've definitely seen some fundraising stories where I think if the investors did believe in those numbers, they would be foolish not to invest. And so the
Right.
fact that a round did not close leads me to believe that no, the investors did not think that was a believable model, and these numbers, yeah, they look kind of crazy.
Right. And a model is an assumption. It's an assumption of the future. So like if you assume 7,000% growth, the investor's going to say how,
Right,
right?
right. And you'd better have a very good story for how you're going to achieve 7,000% growth. Absolutely.
I mean, I'm saying a crazy number, but it's like those are the numbers that like makes them question like how are you going to get there? Like what is it? What are you doing that's different
Right.
to get such
Absolutely.
insane growth? But awesome. I know we're coming up at the top of the hour. I guess like some closing questions for you like where can people find you? And like, what's the best way to reach you personally?
Yeah, absolutely. Well, I don't know if you have show notes and can leave maybe my LinkedIn profile and my email in the show notes. But happy to connect on LinkedIn. My name is Kim Walch. It's WALCH. And happy to take emails at Kim at rio-finance.com. And yeah, would love to connect with some of your listeners and see if there's, any opportunities to work together.
Last question before we end, like what parting advice would you like to give everyone that's listening? Like people that want to get into finance or founders or investors, like what's some really good parting advice?
I think it's very understandable to me that founders don't get excited about the idea of investing in G&A, right? Like you invest in R&D because you want to build a really cool product. You put money in sales and marketing because you want to have lots of customers and have lots of revenue. the G&A side, it's not as sexy to put money in. It's not as exciting. And like, no, you should not be spending a tremendous amount of money on G&A. Like that is never going to make sense. But I think it's really challenging when companies underinvest, and I've seen some very real mistakes. I've seen, some very costly mistakes that were made that someone with a little bit more expertise could have caught and could have saved the company a lot of money. And some of it's just not filing things on time or just not having the right information, making a mess, reporting messy numbers to your investors. That doesn't look good. So I just think it's really well worth it to find someone, to work with someone who has the right skill set and who can really help. And even if that's not the cheapest option, like quality over price is going to get you a lot of value, and it's really going to be worthwhile in the long run.
Awesome. Awesome. Well, thank you so much, Kim. This was a great episode. I really appreciate all the advice. I learned a lot actually on this interview as well. So, but
Oh, well, thank you so much, Daniel. It was so great to be here. Thrilled to have been a part of the podcast. Yeah, thank you again.
awesome. Thank you.